Let's talk a little bit about this bond bear market. You call this a bear market, but one that's not dangerous for bond investors. What does that mean?
Well, I think it's more of a 35-year bear market that's just coming out of hibernation. It's March. The bear is starting to wake up, growling a little bit, but not significantly. It means, in fundamental terms, that 10-year treasuries, which are now at 2.55, probably over the year will go to 275 or 280 for a number of fundamental reasons. And that, yes, that's a bear market, but it doesn't really significantly affect total return in a negative way for bond investors. It leaves them, in my opinion, flat for the year of 2018.
Right, and in fact, you say annual returns should still likely be positive. Do you see the 10-year getting to 3% and above and thereby spilling over and hurting equities?
Well, that's certainly possible. I think 10 years have broken a number of technical barriers in the last few days, in the last week or so, and some of the fundamentals are working against them. For instance, the nominal U.S. GDP is probably inching closer to 5% than 4%, and typically, ever since the era of financial repression beginning in 2009, the spread between nominal GDP and 10-year treasuries has been about 140 basis points. So if we got to 5% nominal GDP, which I think is possible in the next few quarters, then a 360 10-year is possible. I don't see it going that high, but 3% is possible, yes.
Bill, when you look at your outlook for the year of 2.7% or whatever it may be across the yield curve, what would be optimal for your investments, for your positioning right now? Because as I look at some of your returns, you've been lagging some peers. So I wonder what would be the best scenario for you, that would allow you to catch up a bit?
Well, my unconstrained fund is a very low volatility fund. It's more like a low duration or even close to a money market type of fund. And the returns have been, very, very good relative to those benchmarks. What I see as an opportunity is not necessarily investing in treasuries or not necessarily investing in global bonds, but in some cases selling them. German 10-year bonds yield only 50 basis points. UK gilts 10 years yield only 1.4%, and they have inflation above 3. JGBs in Japan yield only 10 basis points. So to my way of thinking, this is the beginning of a global movement, and treasuries are certainly leading the charge with Fed increases over the past 12 months, but other central banks are catching up in terms of reducing quantitative easing, and as the ECB hinted last night, perhaps changing their outlook on monetary policy going forward.
Yeah, that's right. They acknowledge that communication on monetary policy will need to change. We saw the euro rising. We saw two-year yields in Germany spiking. If we get a repricing of Europe, what kind of effect does that have on the Treasury market? How does that change the value proposition of U.S. debt on the short end and on the long end?
Well, I think it does. For instance, over the past 12 to 24 months, a lot of Bund investors have sold Bunds to the ECB and invested in U.S. Treasuries at a pickup of 200 basis points or more. To the extent that Bund yields rise, it makes them more attractive to domestic investors and insurance companies, and therefore lessens the buying of Treasuries. So, there's no doubt that there's a global connection in terms of yields. There's a large disparity between them, but they tend to move together during periods of central bank tightening, and I think we're beginning to see that now almost on a global basis.
Bill, speaking of connections, as Scarlett alluded to, you made the Oprah connection and the men connection in your in your investment outlook that is out, and you sort of make some jokes about men in general, and you say, I could go on and on, I won't, I don't dare. I'm curious why you dared, though, to make the joke. You tend to have provocative posts and sort of attention-grabbing jokes at times in these investment outlooks. I'm curious why you waded into this one.
Well, because I think it's topical and relevant, and it needs to be brought to the surface. I did that in a rather comical way by talking about men and some of their problems, but in a sort of in a joking fashion, but at the same time suggesting that women, since the biblical Eve, I guess, had gotten the short stick or the short rib, and it was time for continuing change. So I think my outlooks have always been for 10 or 20 years, yes, controversial, but hopefully, provocative from the standpoint of social change.
You say you're with Oprah for president. Does that mean you'd support her in 2020?
Well, I like what she said, and I like how she said it. Let's put it that way. She doesn't necessarily have political experience, but who knows? I think it's time for a change. It was time for a change ever since last November when Trump was elected, and obviously Hillary Clinton is not going to be that future change. So let's start looking at some potential candidates, and Oprah's a strong force in terms of opinions and in terms of voicing those opinions.
Oprah would certainly be a wild card, right, in the political arena. To bring it back to the bond market, as we draw these analogies, are there any wild cards this year? It seems as though the landscape is pretty mapped out. Is there anything unexpected here? Is it just a matter of inflation, for example, that you're on the watch for this year?
Yeah, I think so. But, the bond market is anticipating slightly higher inflation. We see oil prices. We see the possibility of higher wage gains now with Walmart raising their minimum wage, et cetera. Although that has a small effect, it's probably the beginning of a movement. So unanticipated inflation, the break-evens in the tip market, 5, 10, 30 years out are about 2%. And so, if the CPI tomorrow gives us a sign that perhaps 2% is just a minimum target, then, bonds could suffer going forward. So I'd watch the inflation outlook, not just in the U.S., but in the ECB and maybe even in Japan.